Hi students, I am Reji Vinod. Welcome to Pavitra Academy online classes. Today I am going to explain how to prepare journal entries in a simple way. So first step in accounting is recording. Recording is done through journal entries and subsidiary books. So for writing journal entries we have traditional and modern approach. Modern approach is more easy. So I will explain the journal entries through modern approach. As per modern approach, the accounts are classified into assets, expenses and losses, liabilities, incomes and gains. In this, asset, expenses and losses have debit balance. Why? Because while purchasing an asset and incurring an expense, we lose money. Or money is something that has monetary value either today or tomorrow. And for liabilities and incomes and gains, we have credit balance. Why? Because while creating a liability or receiving an income, we gain money or something that has monetary value either today or tomorrow. In a business, cash is the king. So cash will always show a debit balance. So based on cash, we can explain the balances of other accounts. So as per modern approach, we have four types of accounts: asset, expense and losses, liabilities, incomes and gain. In that, assets and expense and losses have debit balance. Why? Because we lose money. Liabilities and incomes and gains have credit balance. Why? Because we gain money. But why the difference in classification? It is because of use. For asset, we have future benefit. For example, if I purchase a computer and I can use it for a long period of time, normally in business the time period for such measurement is 1 year. So if anything which can be used for more than 1 year is an asset. But for an expense, the benefit is for less than 1 year or the benefit already exhausted. Example, electricity bill, salary paid, water bill, etc. So simply we can say for asset, first pay and then use, and for expenses, first use and then pay. Similar way, for liabilities and incomes and gains, we have credit balance. Why? Because we receive money. For example, if I took a loan, I receive cash. But the difference is, for a loan or for a liability, I have an obligation to pay back such liability. But for incomes and gains, we don't have an obligation to pay back. So for an income, we receive money but no obligation. For example, if I receive salary rupees 10,000, it is my money, I don't have to pay back. So it's an income for me. So debit and credit is basic nature of accounts. That is, asset and expense have debit balance, liabilities and income have credit balance. So based on the discussion, we can conclude that for asset and expenses, the common nature is loss of money. Here also we lose money. But for asset, we will get future benefit. For expense, benefit already exhausted or benefit is short term. This is long term use, short term use. That is, benefit is for more than 1 year. This is expenses, benefit is for less than 1 year. And assets used for preparation of balance sheet, that is position statement. That is used to know our financial position. Expenses used to know our profit or loss of the business, that is P&L account. And liabilities and incomes, what is the common nature is receipt of money. That is, we receive money. For income also we receive money. But for liabilities, obligation to pay back. Income, no obligation to pay back. Liabilities used for preparation of balance sheet and income used for preparation of P&L account. That is common nature and differences. So based on this, rules of accounting as per modern approach. Increase or purchase of an asset, debit balance. Why? Because basic nature is debit, so increase also debit. Decrease or sale of an asset is credit balance. Why? Because basic nature of an asset is debit. So decrease, opposite, that is credit. The same way, increase or incurring of an expense, debit balance. Why? Because basic nature is debit. Decrease or cancellation of an expenses, credit balance. Why? Because basic nature is debit. So decrease, credit. Increase of liability, credit balance. Why? Because basic nature is credit, so increase also credit. Decrease or repayment of a liability, debit. Why? Because basic nature is credit, so decrease, debit. Increase of an income, credit, basic nature is credit, so decrease we have to debit. So simply we can say assets and expenses debit, liabilities and income credit balance. Next, format of journal entry. In the format of journal entry we have 5 columns: date, particulars, ledger folio, debit, credit. In date we have to record journal entries date wise, that is chronological order, date wise. In particulars column we have to write name of accounts, and in ledger folio the page number of ledger book where these accounts have been recorded. So next to this debit amount, fifth column is credit amount. So I will explain the modern approach through examples. First one, X commenced business with rupees 50,000 cash. In this transaction, X is the owner of the business and he put 50,000 into the business. Means business received rupees 50,000 from Mr. X. He is the owner. But in accounting, business is separate from the owner. It is an entity concept. So while writing journal entries, we have to write journal entries from the point of view of business. So business received 50,000 rupees from Mr. X, even if X is the owner. So in this, accounts involved are Mr. X, owner, and business received cash. So business received cash from Mr. X, who is owner. So this amount is a liability for the business. Means in future the business has to repay the money to Mr. X. So for Mr. X business, Mr. X is a liability, and what is the balance? For a liability it is credit balance, and business received cash. For cash is an asset. Asset is debit balanced account. So how to write journal entry? Cash account debit to what the amount to be credited? Mr. X. X is the owner. Owner's account is called capital account. Amount is 50,000. And next is narration. Narration is nothing but explanation of this transaction being started business with a capital of rupees 50,000. Next example, purchased goods for cash rupees 20,000 and for credit 30,000. Here business purchased goods worth total rupees 50,000. In that 20,000 paid and 30,000 yet to pay. So in this transaction, accounts involved are goods. Normally goods purchased, the account name is purchase account. Next is cash account, and the credit, name of the creditor is not given, so the common name is creditor account. And goods purchase for the business, it's an expense. What is the nature of business? Expense, it's debit balance. Cash, here cash is an asset, but what happened to cash? Business paid the cash, so it is reduced. Reduced means basic nature of cash is debit balance, but while reducing we have to credit it. And creditor for the business, it's a liability, so credit balance. The two accounts to be credited, one account to be debited. So purchase account debit 50,000, to cash account 20,000, to creditor account 30,000. Here are one journal entry, 3 accounts are involved. This type of journal entry is called compound journal entries. So being goods purchased for cash and on credit. third example, sold goods for cash rupees 40,000. So here also sales, goods sold means it's sales and cash received 40,000. So accounts involved are goods. So goods sold means the account name is sales. For purchase of goods, account name is purchase. Sold goods means purchase, account name is sales, and the amount received is cash account. So sales, it's an income for the business. What is the balance? Income means credit balance. Cash is an asset. What is the balance? Debit. So account to be debited is cash, credited is sales. Journal entry is cash account debit 40,000 to sales account 40,000. What is the narration? B, sales made. Rent paid rupees 500. Here also business paid rent rupees 500. So what is the accounts involved? Rent. Rent is an expense for the business. Rent and cash. Rent is an expense for the business. For expense, what is the balance? Debit. Cash is an asset, but in this cash reduced means cash paid. So reduced credit balance. Rent account debit to cash account being rent paid. Next, bought furniture on credit rupees 5,000. Here furniture purchased by the business, but the amount not paid yet. So it is credit. Furniture account and creditor account. The name is not mentioned, so common name creditor. Furniture is an asset. Future benefit are there, so asset. What is the balance of asset? Debit. Creditor, it's a liability. So what is the balance? Credit. How to write the journal entry? Furniture to be debited, creditor is to be credited. So furniture account debit to creditor account being furniture purchased. Next, bought refrigerator for personal use rupees 5,000. Here personal use means that owner's use. So owner purchased the refrigerator for personal use, but the amount given by business. So in this case 5,000 paid by the business, but the refrigerator taken by owner. So it is a transaction involving capital. So capital means the owner, but he is taking money from business means, so it's a drawings. So as per in journal entry, if the owner took something from the business, it is called drawings account and cash account, not refrigerator, because he took money from the business and purchased refrigerator. So the accounts involved are capital, drawings and cash, and it's a capital account is a liability, but what happened? It reduced. So we have to debit it. Cash account is an asset, it also reduced, so we have to credit it. How to write the journal entry? Drawings account debit to cash account. Narration is being drawings made, not purchase, so it's a drawings made. Next, sold goods to Mr. D on credit rupees 1,000. Here sales to Mr. D on credit means money not received yet. So goods sales account and Mr. D. So common name of the person is debtor. It's like creditor, debtor. So he is debtor, and for sales it's an income. What is the balance? Creditor. Mr. D is a live asset, is an asset. So what is the balance? Debit. Why asset? He has to pay rupees 1,000 to business. So for the business it's an asset, means it's a receivable. So it's an asset. So debit balance. Now how write the journal entry? Mr. D account debit to sales account 1,000 being sales made on credit. Next example is received cash from Mr. D rupees 900 in full settlement, means in the previous transaction the sales was for 1,000, but in this transaction Mr. D paid 900 rupees to business, but full settlement. Full settlement means 100 rupees he is not going to pay. So 100 rupees is lost to the business. It's like a discount allowed by the business. So accounts involved are cash. Cash received how much? 900. Discount allowed how much? 100. and Mr. D is debtor. So cash is an asset, received, no, so it's a debit balance. Discount allowed, it's a loss to the business, so debit balance. Mr. D, asset, but it's reduced, he paid the money, so reduced, so credit. How to write the journal entry? Cash account debit 900, discount allowed account debit 100, to Mr. D 1000, being cash received from Mr. D on full settlement. Next, purchased goods from Mr. Z on credit rupees 1000. Here also goods purchased and Mr. Z money not yet paid, so cash is not involved. Accounts involved are goods purchases and Mr. Z creditor. Purchase account is an expense, debit balance. Mr. Z is a liability, credit balance. So how to write purchase account debit to Mr. Z account, being purchase made on credit. That's all. Next, goods returned to Mr. Z rupees 200. So in the previous example, we purchased goods worth rupees 1000. From out of that goods, we returned rupees 200 worth of goods. So the accounts involved are goods returned. So the name of the account is purchased goods returned. So that is called purchases returns, and to whom we paid? Mr. Z. Goods purchase return, goods purchase is an expense, so opposite to expense, reduced. Credit balance, Mr. Z liability was there but it is reduced, debit balance. So what is the journal entry? Mr. Z account debit to purchase returns account 200, being goods returned. Next, paid to Mr. Z full settlement rupees 700. So in the previous example, there was 1000 rupees purchase, in that 200 returned. So net amount to be received is 800, but 800 we paid 700 and it is for full settlement. So no balance is there. So what is the account involved are? Mr. Z, to Mr. Z we paid the amount, but not total 800 rupees. Only 700 paid for full settlement. So 100 rupees is our gain. That is called a discount received by the business from Mr. Z. So discount received, and what received? What we paid? Cash. So Mr. Z, it's a liability but reduced because we paid money to Mr. Z. So liability reduced. If liability reduced, what is the balance? Debit. Discount received, it's a gain for the business. So for gain, what is the balance? Credit. And cash we paid. So asset reduced, what is the balance? Credit. So Mr. Z account debit to discount received account to cash account, being cash paid to creditor. So there are so many examples of debit balanced accounts. I will explain some of them. Heads of account, balance reason. First, wages. Wages means wages paid to workers. Why wages have which balance? Debit balance. Why? Because it's an expense. Next is carriage inward. It is transport charges. It's also debit balance, expense. Freight, it is also transportation charges, debit balance, expense. Bad debt. Bad debt means the debtors not paid money to business, so it is called bad debt. So debit balance, losses. Commission paid, it's also debit. Why? Because expense. Repairs, debit, expense. Salaries, debit, expense. Furniture and fittings, debit. Why? Because it's an asset. Investments, debit, asset. Cash in hand and at bank, debit, asset. There are so many other examples. Next, examples of credit balanced accounts. Heads of accounts, balance, reason. Capital, what is the balance? Credit. Why? Because it's a liability. Commission received, credit balance. Why? Because it's an income. Loan taken, credit balance, liability. Interest received, credit. Why? Because it's an income. Sundry creditors, credit. Why? Because it's a liability. Bills payable, credit, liability. Grant from government, credit, income. Rent received, credit, income. Bank overdraft, credit, liability. Income tax refund, credit, income. Bad debt recovered, credit, income. So in this class I explained simple journal entries. In the next class I am going to explain advanced level of journal entries. So thanks for watching. Thank you. ഞാൻ പോസ്റ്റ് ചെയ്തു.